Let me start with a conversation that I had with an investor because he told me something that I hear all the time. And that was, Carmen, I'm not going to get whole life insurance because it's too expensive. I'm just going to buy term and invest the difference. And on the surface, that sounds logical, right? It's hard to argue with. And the point is if the market averages are strong and the returns are fantastic, then logically, this could actually work. Strategically, this could work. So instead of arguing with him, I just asked him one question. You ready for the question? And that question changed everything. I just simply asked, if your income disappears tomorrow, what happens to your investment strategy?
Mm-hmm.
My name is Carmen.
And I'm Darius. And every investment strategy on earth depends on one thing: your ability to produce income.
What was that?
Your ability to produce income.
Okay.
And the thing is, if this disappears, then your investment strategy disappears with it, because there's no inflow into the investment.
No inflow into the outflow. If we're going to call it that. Now, here's the pain. Let's bring the pain to the concept, right? If I asked you just one thing, and I said, if your investment account disappears tomorrow, can you rebuild it?
Yeah, I can do that.
You can do
I
that?
don't have no problem with that.
Okay, right? Because guess what? You still have what? Your career, your business, your skills. You still have your ability to produce income, don't you? Right? So now let me ask you a different question. If your ability to produce income stopped tomorrow, can you still rebuild your investments?
And that's when you get the pause. Well, you know what? Y'all just don't know what y'all talking about. Y'all playing these games.
That's where we get the And this is when people recognize something very important, is that your investments are not your greatest asset. Your ability to earn income is your greatest asset. And this is exactly why economists call your ability to create income as your human capital, because this is going to refer to your economic value of your future earning potential.
Yeah.
Human capital.
And that's what the banks use when they give you credit cards, is they calculate your future earning potential. That's why they give you credit on something that you have no collateral, because they've been able to leverage
Your
systemically
future
your future earning potential.
Mm-hmm.
For most people, during their working years, this is their largest financial asset. Yeah, it's the one asset that most people fail to protect. Now, why is that? Because it's not sexy to protect my income. It's sexy for me to go and do this investment, to buy term and invest the difference, because it's logical, and that's what people say. Here's the misunderstanding as to why investors skip the income protection. And it comes down to three misunderstandings. The first is they value growth more than protection. That's number one.
It's sexier, right?
It is. It gets the most play. And it gets the most views, and this is what people are searching for. The second thing is they think insurance is just a cost rather than a financial infrastructure.
I can't tell you how many times people tell me that.
It-
Like, why would I put so much money on this? It's not guaranteed that I'm going to die. I'm like, bruh.
And it goes back to the fact that it's not cute, it's not popular.
Mm-hmm. Mm-hmm.
And the third thing is they believe that investing alone creates wealth. And the thing is, investing doesn't create income. Income creates investments.
One more time.
Investing doesn't create income. Income creates investments. Now, the important thing to understand is that ultra successful people do things that aren't very popular to the masses. What's popular to the masses is luxury items, as an example. But you haven't seen what successful people do before they become successful. They don't have any of those things. And it's the things that you don't see which gets people the most leverage and the most jump in increasing their income or growth for themselves, is the unsexy things like buying life insurance.
How about that? So Wealth Nation, what we want to make sure that we can teach you all is the very specific order in which one must build wealth. Are you all ready for it? Here's a pen and paper. Here's 4 levels to this. First, we need to protect our income. Simple as that. Protect the number one asset. 2, control that income.
Mm-hmm.
How about that? 3, store the income, meaning liquidity. Don't we need liquidity to invest? And then 4, let's start investing, family. Investing that capital. It's that simple. Protection, control, storage, and then investing. And most people want to start at step number 4 because they just want to jump straight to investing. But if they skip all the way to step number 4, that means that their foundation is weak. Cue the B-roll. And this is exactly where the strategy is weak.
Now, let's address a common argument, which is to buy term and invest the difference. And here's how the strategy usually goes. Someone might compare 2 options. They have a whole life insurance policy that costs $1,000, and then they have a term policy that costs $50 a month. Both of these are monthly premium payments. So instead of paying the higher premium on the whole life insurance policy, they invest the difference. And on paper, that sounds efficient. That makes sense. It makes
On
sense.
paper.
Yeah, it makes sense if life goes perfectly
And if you're actually investing the $950 consistently.
every single month. But the strategy assumes something very important. It assumes that your income continues uninterrupted.
Uninterrupted.
And that's where risk enters. Because if that income stops, then the investment stops. You see where we're going here?
Pause. We need to go back to this whole process. If the income stops, the investment stops. It's that simple. So when you tell us that you want to buy term and invest the difference, we understand from a cost standpoint how like emotionally that decision might make sense today. But when we think about it through the big picture and we actually take the time to let the numbers speak for themselves, it always proves a different point.
Right. And not even stop. Maybe it slows down. Maybe instead of passing away, maybe something happens where you have some disability, you only get a certain amount of your income. It slows it down. It still affects the investment.
Yeah, because compounding requires consistent inflows, doesn't it? Because without income, right, the system breaks. And the other risk to this is that the sequencing of returns.
Yeah, that's a biggie.
Right? This is a huge one because if the market declines and you're in a withdrawal period, that can permanently damage the growth of your portfolio. Right? Think about that. How many times have you tried to borrow money or take money out of your investments in a down market? You definitely don't want to do that because how many times have you maybe tried to access your money in your portfolio in a down market because you needed the money and then maybe you were forced to sell assets because you didn't have what? Liquidity. You didn't have the income. How about that? So risk number 3 is just all about behavioral risks.
So research has shown repeatedly that investors, and we've seen this firsthand, investors tend to underperform the market due to emotional decisions such as panic selling or poor timing. Liquidity helps reduce those mistakes. Risk number 4 is opportunity timing. Some of the greatest investment opportunities appear during major market downturns. For example, the 2008 financial crisis, that's when people needed money. But if you were liquid and you had the funds, you could have capitalized on that. Another one, recent one was COVID, the COVID market crash.
And wealth always transfers because during those down markets, the people who have liquidity win. How about that? Because liquidity matters.
The moral of the story is
Liquidity matters.
there it is. So whole life insurance is often misunderstood because people think it competes with investment.
Oh, that's a good one.
It doesn't compete with investment. It's just it plays a different role.
Yeah. Where in life insurance does investment sound?
Yeah.
It doesn't. You can't make that word out of it, right?
And here's where a properly structured policy, it can provide 3 things. Number 1, it can be income protection through the death benefit. It could be liquidity through the cash value and stability because the policy value is not directly correlated with the market.
That sounds like
It's not influenced by the market at all.
diversity. Doesn't that sound like diversity?
It sounds like covering your assets. Assets. Sounds like covering your assets.
And the other thing to consider with a mutual life insurance company, for example, they've paid dividends with some companies hundreds of years consecutively because we work with companies who do pay dividends consecutively. And if we address the Wealth Nation framework, for us, it's all about teaching our students about creating a solid financial ecosystem because we want you to be able to picture your income flowing into your system, that your money is moving in specific directions intentionally. First is protection, second is capital storage, and then third, let's talk about investing. The mistakes many investors make time and time again is they skip step 1 and step 2. So the point is, in order for you to build a resilient system, You have to follow the steps 1,
Right.
2, and 3.
Right. And this is the difference between a investor and a lifestyle owner. Investors chase returns while lifestyle owners protect the system that produces the wealth.
Mm-hmm.
Because when your system is protected, you can invest aggressively with confidence, without any issues or worries.
Mm-hmm. So the final question that we're going to ask you, family, is do you value your investments? Or do you value the income that makes the investments possible? Because once you value the source of wealth, family, protecting it just becomes the obvious next step.
Mhm.
So if you want to understand how to properly protect the source of wealth, click on the link below,
Remember to own your own lifestyle.
or someone else will.